What I really want to talk about, besides the drama of the Turks and Caicos overnight, and then coming up in the likelihood of somewhere in the vicinity of even of Miami and the granular Miami Beach, how are the home risks different than Hurricane Andrew some 25 years ago?
Sure. Well, the main difference is that you have a large majority of these homes have mandatory insurance forced upon them by Fannie Mae after Hurricane Andrew. So before then, it was really optional if they wanted to have flood insurance or hurricane insurance.
We learned billions of dollars at the time.
Yes, correct. And you had a mass exodus of insurers after that time with all the losses. So the state came in and said, we're going to put together a program, and they put together the Florida Cat Fund to, one, entice insurers to stay in the state, keep insuring these homes, and then Fannie Mae stepped in and said, we're actually going to force homeowners to have this insurance policies at the time of purchase. Now, there have been times that some homeowners have dropped the coverage subsequently, but the majority of the homes should be covered.
Your expertise with Bloomberg Intelligence is not only the insurers, but the reinsurance of the insurers, spreading the risk out within the business. I look at that as a gentleman's game in Hamilton, Bermuda. People wear shorts, they wear the knee socks, and everybody goes to 3-hour lunch. That's not the way it is. This is a really tough business.
Yes.
What's the risk of the reinsurers right now?
It's pretty high right now. I mean, you're talking losses, I think we estimated yesterday about $130 billion. That's compared to Andrew, where it was $26 billion. And over the last 10 years, there haven't been any major storms to really whip through Florida. So the reinsurance market has really been priced inappropriately, in my opinion. Just this year, the Florida Cat Fund added about a $1 billion overlay onto their policies, and it was at the cheapest level they've had in the last 3 years. So that just goes to show you that the reinsurance market really wasn't pricing in any storms.
Right, and in terms of pricing in and risk then, Eric, I've got this chart here of cat bonds showing the index and the losses to the value, first from Matthew, and then here we've got 2016 as well, showing there on the chart from Hurricane Sandy. Are investors adequately compensated for the risks of these cat bonds?
I don't think so right now. The actual payoff of these things could be, nickel on the dollar, pennies on the dollar. And no one was thinking that a storm would come through of this size, especially with the 10-year lull. And then, the risk isn't just with Irma; it's the storm subsequently behind it, and it's just a very busy storm season that no one was really expecting.
What does the Hotel Betsy do in Miami Beach? I've stayed there. They got the beautiful roof deck. It's like the arrows pointing at the Hotel Betsy. What does like a business do in Miami Beach, waking up today and seeing that arrow point at them? Will they be covered? Will that gorgeous romantic porch of the Betsy Hotel be covered?
So most of these businesses have, loss prevention policies in place. They have insurance overlays in place, for any sort of damage, and hopefully they have hurricane insurance in place as well. I think the bigger risk longer term is the economic loss. So there was a study done a couple years ago that looked at the economic damage to coastal communities subsequent to hurricanes. And, on the coastal communities in the southeastern U.S., you had a 1.7% growth rate. That ticks down to about 0.6%. So there really is the propensity for economic loss.